11 state pension fund just lost 337 million betting on Bitcoin through MicroStrategy. Meanwhile, 30-year Treasury yield is giving around 4.9% yield. That's highest since September. Everyone is talking about Bitcoin crash, but here is what actually you're missing. This is not about a crypto story, and this is not about retail traders. These are CalPERS, Florida Retirement System, Wisconsin Pension Fund, and these all have around 550 billion in combined assets. Fiduciaries managing people's assets who are teachers, firefighters, and public workers. And all this capital is down around 60% in 6 months. And this is itself a regulated Bitcoin exposure, but we are still seeing a 60% down. But here is something critical. Are they selling the Bitcoin because it's failed or because something else is offering better yield than Bitcoin? And this answer will determine whether we are currently facing is a temporary correction or structural capital allocation on the face of Bitcoin. Let's analyze the data. I'm calling this as a capital relocation framework, and it has 3 components, and I will explain what actually happening in the market right now. The component 1 is the risk premium collapse. Bitcoin's value proposition to institutions were always asymmetrical upside against fiat debasement. But you need to look what actually the math telling right now. In the 30-year Treasury, there is 4.9% yield. It's government-backed, zero volatility, but Bitcoin, it's literally 45% down from the October 2025. That's literally 90 days realized volatility at 68%. For a pension fund with a fiduciary duty, it's not about Bitcoin will go up, instead, but it has the potential upsides to justify the volatility cost versus the 4.9% yield from the Treasury bills. And here is the data point that nobody is talking about. That 4.9% yield is after adjusting for the term premium spike on February 2nd. The bond market just repriced the long duration risk by 20 basis points in a single session. This is literally institutions saying we want more compensation for holding a long-term government debts. Why they are expecting something like this? Because they are expecting sustained inflation and more hawkish Fed under the new leadership. Kevin Warsh is being floated as the next Fed chair, and he is known as an inflation hawk who want aggressive balance sheet reduction. Let me show you something really crucial here. Bitcoin's 30-day correlation with S&P 500 is around 0.78, and Bitcoin's correlation with Nasdaq is around 0.73. This is literally a catastrophic for the institutional thesis. Pensions fund bought Bitcoin as a portfolio diversifier, a hedge against traditional market risk. But the data from February 2024 through this day shows Bitcoin is increasingly trading as a high leveraged tech stock. When Nasdaq dropped around 2% on February 5th, Bitcoin fell 10% in 24 hours. This is a 5x beta move. This is not a diversification. This is just amplifying the risk. And the fundamental reason for this is simply clear. It's because of the spot Bitcoin ETFs. Institutions made Bitcoin more accessible to the individuals, and it also make it correlated much more better. Now when the risk of sentiment will enter into the market, the Bitcoin will sell along with all other assets as well. This is no longer an alternative asset right now. It's a high beta risk asset. Here is what timing matters. The strategy, that's MicroStrategy, just bought Bitcoin around Q3 of 2024 and Q1 of 2025. This is the point where Bitcoin was rallying post-halving and post-ETF launch. And CalPERS bought around 448k shares at an average price around 322. Now that price is around 135. That's literally 58% loss. Not just unrealized, it's paper losses that trigger the fiduciary view. The public pension funds were actually operating with legal mandates to minimize the risk right now. They can't ride out this kind of volatility that Bitcoin's providing, just like a hedge funds. When the Treasury yield spikes around 4.9% and Bitcoin's correlation with equities stays elevated, the pension community faces a binary choices. Option A will be hold and losing, like volatile position that's already down 60%. Option B, rotate into guaranteed 4.9% yield, and that reduces portfolio volatility. The framework, the capital allocation framework, just predicts that they choose option B. And I will be wrong if you see the pension funds were increasing Bitcoin allocations before June 2026, or if Treasury yield went below 4.2% on sustained Fed dovishness. Let's look into the actual carnage step by step here. 10 other funds are showing the identical patterns here. That's literally 60% average loss across the board. But here is a contrarian data that changes this narrative. AMP Super in Australia, a pension fund that's managing around 39 billion, reported in November 2025 that the member demanding for Bitcoin exposure was overwhelming, and contracts under were flooded with the request of moving the retirement savings into Bitcoin funds. So what's the difference? timing and structure. AMP made a small allocation through Bitcoin futures in their dynamic allocations program, not a leveraged equity exposure through the strategy, and they did it when the Bitcoin was consolidating, not at the peak at the time of FOMO. The lesson here is that it's not about pension fund can't hold Bitcoin. It's the reason that they can't hold the leveraged positions. Concentrated Bitcoin bets were bought at the top. The bloodbath is not about Bitcoin itself, it's about the position sizing, timing, and structure. Now let's discuss where actually the money is flowing, not actually where it's leaving. On February 2nd, 2026, the Treasury market experienced what traders calling a bear steeping event. This was not gradual, this was institutional money is repricing long-term government debt violently. The catalyst, the two-part punch. The punch one is macro data beat. The ISM manufacturing index just printed around 52.6 versus expectation of 48.4. That's literally 26-month contraction period just ending. That means US economy is not slowing down, it's re-accelerating. This means sustained inflation risk. Punch 2 is Fed leadership change. Jerome Powell's term will experience in May 2026. Now the White House is pricing Kevin Walsh as the next replacement, a hawkish person who wants the aggressive balance sheet reduction and prioritize inflation fighting over growth support. This situation market immediately repriced for higher rates for a long period with less liquidity. And here is what it means for the capital allocation in this case. The Treasury Borrowing Advisory Committee on February 3rd report said that the credit spread is remained tight. The VIX is 16 near the multi-year lows. That means implied volatility is at historical low period right now. Translation: investors are paid premium yield for low government debts. The risk-reward math just flipped in this case. On February 6th, gold hit around 67% gain and year over year. Now institutional money is rotating into safety, but not just at gold. Let's look at the Treasury auction demand right now. The US Treasury maintained issuance guidance for favoring short-term bills over long bonds, especially for managing the borrowing cost amid the elevated rates. But institutional buyers are stepping up for the long duration paper at 4.9%. Why? Because the smart money is seeing the math here. 4.9% guarantee for 30 years will beat the speculative assets in high volatility and high inflation regime. I will be wrong if Treasury yield went below, like less than 4% on sustained Fed dovishness before Q3 of 2026, or we see a pension funds rotating into Bitcoin in this period. This is where institutional Bitcoin thesis completely breaking down. Bitcoin moved around 5 to 6x leverage to equity indices, not divergence, simply amplification. Research from BuyTree published an analysis on February 4 showing Bitcoin now trading like an internet stock with a 0.73 correlation to iShares software like ETF. That ETF, Microsoft, Oracle, Salesforce, Adobe is down 18% this month, and Bitcoin down literally 40% from the peak. The data is unambiguous. Now Bitcoin has become the high beta tech proxy, not an uncorrelated portfolio diverser. So what does this mean for Bitcoin and for markets and for you as an investor? There are three scenarios right now, and we are discussing weighted according to the probability of chance. The first scenario, like the 35% probability. In this case, the more pension funds will dump Bitcoin in the period of March to April 2026. Bitcoin finds supports around 50 to 55k, and institutional interest shift to wait and see mode for a 12 to 18 months. And retail dominates the crypto market again, higher volatility and low credibility. What will be the trigger for this scenario? In this case, we may see 3+ more pension funds are disclosing the Bitcoin sale by April. The investment thesis here is that avoid Bitcoin until correlation breaks and institutional narrative rebuilds. And scenario B, the probability is around 45%. It's called bifurcation. In this case, the smart institutions will differentiate from the FOMO buyers. Like this will be the differentiation between bad Bitcoin exposure versus good Bitcoin exposure, like the MicroStrategy versus direct small allocation. And pension funds will hold around 1 to 2% spot ETF of Bitcoin, and they will avoid the leverage proxies forever. Bitcoin stabilize between 70k to 85k. In this case, the portfolio spices, no core holding. The trigger for this scenario will be we see pension funds are maintaining the Bitcoin allocation or adding direct to the Bitcoin spot ETFs while selling the strategy. In this case, the investment thesis will be Bitcoin survive but plateau as 2 to 3% satellite allocation. And scenario C, that's a 20% probability, the Treasury bubble. This 4.9% yield will be temporary. If Fed cut rates aggressively in Q2 to Q3 2026, recession fear spikes and Treasury yield will crash to 3.5%. In this case, Bitcoin will rally as the liquidity floods back in. In this case, pensions will reverse the course and add back the Bitcoin exposure. The trigger for this will be like 10-year Treasury yield will be below 3.8% before June 2026 and unemployment spikes like above 4.5%. In this case, the investment thesis will be like current weakness is buying opportunity. My base case will be the scenario B, like the 45% chance. The data support bifurcation. Institutions won't abandon Bitcoin entirely, but they will be far more selective. Like direct spot ETF like 1 to 3%, no leveraged exposure, small position size, longer holding periods, and less price sensitivity to monthly volatility. For Bitcoin, this literally means lower peak price potential, maybe 120k to 150k instead of the ambiguous 200k thing. In this case, there should be a floor, like low volatility floor will be there. There should be no aggressive drop of 114k or something, and it will be more stable, less explosive returns. And they will maintain a permanent correlation between stocks around 0.5 to 0.6. But we need to watch as an investor. On March 15, there is next round of 13F filling. In this case, we need to look for did more pension funds will sell strategy. And the second point is that on Q2 of 2026, do Wisconsin, California, or Florida disclose new Bitcoin buys? It's unlikely, or full exit. And Treasury yield. If the Treasury yield break above 5%, the scenario A will be more likely. Drop below 4%, the scenario C. And next thing is Bitcoin correlation. And if this correlation went below 0.4, that means this thesis is invalid and Bitcoin will reclaim diversified status. Let me give you much more detail, but if I am wrong. In this case, the pension fund will add more than 500 million plus new Bitcoin exposure before Q3 of 2026, and Bitcoin correlation with S&P will drop below 0.3 and it will sustain for 60-day basis. And Treasury 10-year yield drop below 3.7% before June without recession. This great unwind is not about Bitcoin dying, it's about Bitcoin is growing up, like moving from a speculative moonshot asset to a much more mature, boring institutional held asset with 3% of the portfolio and around 0.6% correlation to equities. And this is good for the long-term legitimacy, but terrible for the short-term excitements. So the real question is that does pension fund will own Bitcoin, and what type of Bitcoin exposure will be they will allocate if the Treasury yield is giving this much of like paying 5% yield? And this answer will change in real time right now, and this 337 million loss in the market is forcing that lesson. If you want to go deeper on this, my next video will break down whether the Bitcoin Treasury spread is signaling the best buying opportunity since 2020 or structural regime changed that last years. I think this video is helpful for your detailed macro analysis in the case of Bitcoin and the institutional strategies regarding the pension funds and hedging, etc. If you like this type of content, don't forget to subscribe. See you in the next video.